Hi, I'm Roger Montgomery and welcome to this week's Video Insight. The question I'm asked the most is the market going to crash? The answer, of course, is I don't know. Nobody does. Sure, there's evidence that the market is expensive. In fact, some experts describe current pricing as worrisome. Indeed, if you look at historic price to earnings, 1 year forward price to earnings, the Cape-Shiller ratio, which is a cyclically adjusted price to earnings, or even more esoteric ratios, for example, market capitalisation to gross value added. Well, what you find is the market is at an extreme level at the moment. What's important to understand is the market can remain at these extremes for a long time. In fact, one famous aphorism is the market can remain irrational for a lot longer than you can remain liquid. And that's worth keeping in mind. A silly thing to do when the market is expensive is to run for the hills, to sell out. That doesn't make sense. It is true though that if you were to buy into the market today, particularly the S&P 500 or the NASDAQ, you're likely to be locking in a lower return. Remember, another very powerful and worth remembering aphorism is this: the higher the price you pay, the lower your return. On some estimates, buying the S&P 500 today is locking in a return of something less than zero on average over the next 12 years. Again, I don't know if that's true, but what I do know is that there are some alternatives that can give you comfort if you're nervous about the market being expensive. Now, rather than selling out, what you should think about implementing in your portfolios is rebalancing. This should be a part of your annual review. If, for example, you've decided that your risk profile and your risk tolerance or risk appetite is such that you only want 40% in equities, well, if you've now got 50 or 60% in equities because they've done so well over the last few years, it might be time to rebalance back to those original weightings. But where would you, if you were going to trim profits from the most expensive stocks in your portfolio, where would you put that money? Well, some alternatives include private credit and arbitrage funds, for example, where profits are made irrespective of the direction of markets. It certainly does make sense to think about generating attractive returns from asset classes that don't have exposure to equity markets if you're trying to reduce your exposure to those markets. One thing's also worth remembering: when markets are going up, everything seems like it's good. Picking tops and picking bottoms is a fool's game, but rebalancing makes a lot of sense. And that's my answer to the question of whether or not the market's going to crash. I don't know, but rebalancing reduces some of the anxiety. That's all we've got time for this week. I look forward to talking to you again next week. And in the meantime, continue to follow us on Facebook and Twitter.